Hello, everyone, and welcome to the latest LPL Market Signals. Jeff Bookbinder here, your host for today with my friend and colleague, Adam Turnquist. Adam, first market signals of 2024. Exciting way to ring in the new year, talking about markets, reviewing a great 2023, certainly, and sharing some thoughts on the new year. How are you? How was your New Year's?
Good. Happy New Year to you, and lots to talk about when we think back on 2023. Certainly a challenging year, but a great year for equities. We'll go over some of that today. And any New Year's resolutions for you this year?
New Year's resolutions. Well, I guess I'd probably say try to be a little bit more accurate with forecasts. How about that? Because we were too low. We were too conservative. Certainly, if you're going to miss on forecasts, you're better off missing low than high. So maybe that's one. I don't know what. Maybe beyond that, expand the wardrobe. We were just talking before we started recording here that the sport coat collection is kind of limited these days. So maybe expand that. How about yourself?
I think I could qualify for that one. I think my one New Year's resolution was to golf more, but my wife didn't like that. So I'm going to go with sleep more this year. Get to bed a little earlier.
Oh, I like that one. That's excellent. Good health. Good health. So here's our agenda for today. By the way, we took the week off last week, so back to for the first time in 2 weeks. We're going to review last year and last week for markets. Of course, we know it was real strong. Not only that, but it was a strong finish. We are on a 9-week win streak for the S&P 500. I think I got that right, Adam. Next, we're going to go over the weekly market commentary, which you can find on LPL.com. Just posted here this morning. It is Tuesday, January 2nd, 2024, as we're recording this. It is on hits and misses. So what did we get right? What did we get wrong? So we're certainly going to try to get more right than wrong this year. And with our forecasts, as we always do, I guess, sure, we had some misses, but I think our predictions were actually generally better than consensus. So, we've got that going for us. So next, charts to watch. So, of course, that's your specialty, Adam. We've got a lot of great analysis for you, some seasonality, which a lot of people talk about as we start a new year, and we're done with tax loss harvesting. We're in this the Santa Claus rally period, and all of that. So then, of course, as we always do, we'll finish up with a preview of the week ahead with the economic calendar. So starting with the recap. I mean, I mentioned we were up 9 straight weeks for the S&P. Total return for the S&P for the year over 26%. Of course, just outstanding. We have had 2 years that were a little better than that recently, 2019 and 2021. So I think it's the third best year in the past decade, but still we'll take it. Just a little shy of all-time highs on the S&P, but we did end the year with an all-time high on the Dow. So Adam, I mean, if you ask me for just one takeaway on the year, in terms of the markets anyway, it's really about tech and the Magnificent Seven. You see here on the sector column, year-to-date column, you've got communication services, which is where Alphabet and Meta are, up 56% for the year. You've got tech up 58%, certainly NVIDIA and Microsoft, a big part of that, Apple too. And then you have consumer discretionary, which is where Amazon and Tesla are, up 42%. Right, huge year for growth, huge year for tech. So that would probably be my one key market takeaway. What would you highlight, in terms of markets last year that stands out to you?
I think one of the most interesting aspects of last year was just how well seasonality trends played out. If you think throughout the year, we started off with the trifecta. We had a positive Santa Claus rally, positive first 5 days, positive January. Average return for those periods historically is about just over 17%. Obviously, we did better than that this year. But if you go through the rest of the year, the worst month for the S&P was in September. That's historically in line with seasonal periods. The lows were set in the second half in October, another one that's right in line with seasonality. Best month for the year, November, of course, up nearly 9% for the S&P. That lined up with seasonality. So I think it's been pretty interesting to see these seasonal trends play out. It doesn't always happen that well, but last year was certainly a pretty strong seasonal period, or at least aligned with the seasonality pretty well.
Yeah, that's a good point. I think because it was such a growth-led year, it was also the year of the U.S., right? U.S. continued to outperform international, which has really been the trend for most of the past decade. So that stands out as well. And of course, why did the markets do so well? We had a soft landing, we had falling inflation, we had that dramatic drop in interest rates later in the year related to the Fed pivot. So all of that story, wasn't really so obvious to the market that was a great bullish narrative in late October. But I think the 14% rally the last 2 months of the year, certainly the market voted that that narrative was playing out, and the concerns about stubborn inflation and recession had really moved to the background. So I mentioned rates down, remarkable comeback for bonds. I think it was the best 2-month rally for the Bloomberg Aggregate Bond Index since 1982, up about 8%. So you basically went from down 3 to up 5.5 for the year for bonds after November 1st. So just tremendous. We know rates collapsed. Actually, we'll talk about our rate forecast in a minute, but we actually almost got that right. Our original forecast was 325 to 375, and we ended the year at about 387. The problem is we changed it intra-year. Maybe that's a theme, Adam, for the year. We should have left our forecasts at the start of the year alone. They would have been about as good as anything out there, right?
Yeah,
but we changed them. We changed them intra-year, and then ended up kind of regretting those decisions. But nonetheless, if you're going to be wrong, on a stock market forecast, better to be a little conservative, we think, than certainly too aggressive. So strong gains for bonds. The surprise from Lawrence Gillum, our fixed income strategist for last year, I think, was how strong high yield was, right? But the key point I think that he would make in reviewing last year is your starting yields and your end yields were about the same. That left you with a coupon, and the coupons were pretty good. So even though we didn't get much movement in rates from January 1 to December 31st, we got a pretty good year for bond returns. So that's a key takeaway there. I think maybe the disappointing year for oil, although it's good for consumer spending, declines in oil, I think, was another surprise, especially given the geopolitical situation. Anything else you'd call out here?
I think one of the other things that stood out was just over the last 2 months, you noted how the egg had its best 2-month run since the 80s. The 60-40 actually did well. It was bonds rallying and stocks rallying. I think the 60-40 Bespoke put out some research. It was the best 2-month period for the 60-40 portfolio, nearly since 1990, up almost 12% based on the basket that they looked at using the S&P 500. So pretty remarkable run there. And then when you look at energy prices, yeah, big disappointment, especially in natural gas. You can see year to date down almost 50%. You had an unseasonably warm December that really weighed on the overall heating demand outlook and really exacerbated kind of the supply demand imbalance right now for natural gas. But when we look at crude oil, technically, we do think the lows were likely set kind of in the $64 to $68 range. Prices were oversold. We had a little bit of a rally off that level. Obviously, a lot of that's been more predicated on geopolitical risk coming in with over the weekend. Now you have Iranian warships entering the Red Sea, but I think enough to buoy crude oil above that kind of $64 to $68 level. A little more time, though, I think, for upside here. It could be a little bit of a consolidation as we kind of form a base down here.
Yeah, we're hanging in there in the low 70s right now on crude oil. So we'll certainly watch that as a barometer of what's going on in the Middle East. So I mentioned up front that we didn't quite get to an all-time high on the S&P 500, but we sure got close, Adam. I've heard a metaphor from Sam Stovall over at CFRA. We're big fans of Sam's. He refers to new all-time highs as rusty doors. You got to like kick at them a couple of times before they eventually open. That seems to fit this scenario. How long do you think it's going to take us to get through the all-time high? Do you think that's going to happen early this year, or do you think we maybe need to roll over here in the first quarter?
Tough to say. I do like Sam's rusty door analogy. I've heard that one before, so it takes a few pushes to open it up. I think when you look at the broader market and look at some of the other indices, whether that's the NASDAQ 100 or even the Dow Jones Industrial Average and even global indices that have already made new highs, I think it's likely you'll see the S&P 500 follow suit. If you look at the advanced decline index for the S&P 500, which just tracks the number of advancing shares versus declining shares, that's already broken out to new highs. Typically, when that leads, you see the S&P 500 follow. And then on the chart that we brought today, you can see on the bottom panel just the overall participation in the rally. It started off pretty narrow when we kind of gapped above key resistance at 4,400. That was the Magnificent Seven really doing the heavy lifting. However, you did see broad participation build into this market as we went into year end, and again closed just shy of that record high, but I think we'll get there. And then of course the next level you're going to want to watch is 48.19. That's the all-time intraday high, but moving in the right direction. A little bit concerned when you look at it on a short-term basis just how overbought the market is. Typically when you see these kind of parabolic rallies, they do not end in a sideways correction. Typically you get a pullback that retraces generally anywhere from a third to two-thirds of that initial move. So we could see a decent pullback if we start to roll over a little bit here and take a bit of a breather. But the good thing is we're in a bull market, and I think that would be a buying opportunity for investors to re-enter this bull market.
Yeah, a lot of people are talking about participation. I actually have been impressed. The small caps have had a really nice run the past couple of months. And I think something like 90% of the Russell 2 is now over its 50-day moving average. You've got really strong statistic for large caps right above these moving averages. So there's good breadth now. We needed that. You can't just have 7 stocks carry you every year. Really, really good to see a healthy sign for the bull market. How about the 10-year here, Adam? I mean, actually we're getting a little bit of a move higher this morning, back towards 4%. How do you see this shaking out? Is the 10-year kind of finding a floor here, or do you think we could move lower?
I think there's still more downside risk for yields. You can see this developing downtrend that started off right around that 5% level. There's a head and shoulders top formation that developed right around that period. And from there, it's really been a downhill ride for yields, of course, supporting equity markets. But when we look at support for the 10-year, there's some around 360. And as you highlight here, the big support level that we're going to want to watch for 2024 is kind of this, call it 331 area that goes back to the lows that we witnessed in late 2022. I think for equity markets, the best case for yields is just consolidation. Call it sub 4%. Maybe that's the cap on yields for next year. Stocks did very well in that environment. If you look back late 2022 and then into the summer of 2023, yields more or less went sideways, stocks went higher. I think that would be a pretty good scenario for equity markets this year.
Yeah, no doubt. Just like last year, rates are going to be a big key in determining where stocks go this year. So let's go to the painful part of the presentation here, Adam, where we have to talk about what we missed. Although we had some hits too. I guess this is maybe a comfortable miss to talk about, right? We generally got it right that we thought inflation would come down quite a bit, and that the Fed would end its rate hiking campaign. We thought it would end its campaign a little earlier, and we thought maybe inflation would come down a little bit faster. Is that fair?
Yeah, it was a tough year, but we did get the inflation direction, and we did anticipate that we'd get the pause. I think it's just we had this kind of slower than expected cooling in inflation. Of course, a resilient U.S. economy, notably the American consumer, really helped drive that, and I think kept the Fed comfortably higher for longer. As we look at, you can see in the dark blue line with the Fed really pausing in July, but I don't think there was any type of confidence in a pause back in July. It was really until this last FOMC meeting in December where I think the market became confident that the rate hiking cycle is over. And it was really just about guessing the Fed. And if you think back in early 2023, everyone was anticipating kind of the same thing, a pause and cuts. I remember coming as early as the fall. Sometimes they would get baked into, that August, September timeframe. Of course, those got pushed back as the economy did better than expected. So a tough year, but I think importantly, inflation came down to a level where the Fed's now comfortable, no longer raising rates, and the markets welcome that message.
Yeah, and certainly, I mean, we did expect a mild and short recession at some point during the year, and that was expected to bring down inflation. So that's part of why inflation came down maybe a little more gradually than we expected. But we were right in saying, I think all year, that whatever mild slowdown or contraction we might have had, we thought the market was going to manage through it quite well because consumers and companies had been preparing for it, right? And we were going to get that Fed pause. So a few hits, I guess, but certainly some misses in there. So
I'll throw in the housing market. I think that's a win too. When we think about I was reading through our outlook for 2023, and we had noted how multifamily units were surging in terms of the build outs, and that would eventually lower the rent component of CPI, which is a big factor in inflation. And we did see the shelter component of CPI fall considerably in the later half of 2023. And of course, we were relatively bullish, I think, on the housing sector, we'll call it, as well as we kind of witnessed those multifamily units build and just the dynamics playing out with supply in the housing market. So
yeah,
we'll call that a win, I guess.
Great year for home builders, which we had highlighted on a number of occasions. So good call out there. So turning to the stock market, in a sense, I feel really good about this forecast. We started the year 4,400 to 4,500 as our year-end fair value range, and we were there pretty close to the end of the year, right? But then we ended up, having that strong late year rally, pushing the S&P up, north of 4,700. So sure, that was a miss, but consensus. Oh, and we did take the target down 100 points in early summer. So that was a miss, 43.50. We should have left it at 44.50 at the midpoint. But when you compare that to consensus, I highlighted that here on this slide, 4017 was strategist consensus in May, right? And there have been some high profile bulls that have gotten some, positive media attention, certainly. But when you look at collectively the consensus and the majority of forecasters, they were below the 43.50 that we were at for the back half of the year. So I'd call this probably more of a hit than a miss, just based on what our competitors were doing.
Yeah, and we kept the overweight equity recommendation, which was a challenge when you flash back to the banking crisis or mini banking crisis, whatever you want to call it, when the S&P was down to right around 3,800. Of course, you're worrying and flashing back to the global financial crisis and systemic risk sweeping across the market. Of course, no one really knew what was going to happen there. We didn't have very good precedent when you think about the GFC era. So we did stick with our equities overweight recommendation. And at that point, I think I believe in April or May, we also, to take advantage of the dislocations in the banking sector, we went positive on preferreds as well. And I think that would be another hit for LPL Research last year.
Yeah, absolutely. So after the banking crisis, a lot of firms, took their targets down and went underweight equities. Even at S&P 500, 3,800, we hung in there with that equity overweight, and that certainly was proven to be the correct decision. We did take off that equity overweight a little early, right? Wish we were taking it off now instead of taking it off back then. But nonetheless, again, they handled that generally better than the industry. So turning to rates, this is another one where we wish we had just left it. 3.25 to 375 was our forecast at the start of the year, and we just finished a little above the high end, Adam, as it turned out after that collapse in rates over the last couple months of the year.
Yeah, not envious of Lawrence Gillum, our chief fixed income strategist over the last couple of years, predicting interest rates amid one of the biggest rate hiking cycles we've seen in 40 years has been obviously a challenge. We witnessed some huge volatility in the fixed income market, and fixed income volatility is still pretty high right now compared to the VIX. So I think Lawrence is going to have a challenging job ahead for 2024. But again, if we would have stuck with our guns, we'll call it, and held our original forecast, we'd be right in line there. But I think a pretty challenging market for fixed income last year to really nail the number here.
Yeah. So our target is 375 to 425 for the end of 2024 now. So we think rates will be maybe just a touch lower when all is said and done. So I guess we'll move on from that. And this is where we get into seasonality, Adam. And well, first we'll start with the 9-week win streak, which is pretty rare, right? I know we haven't seen one of these since 2004. The statistics to me say we maybe need a period of digestion here in the short term.
So the one-liner, short-term pain, long-term gain. I think when you look at the history of 9-week winning streaks, there's only been 9 of them since 1950. On average, a week later, only a third of those are higher. So pretty low odds in terms of turning this into a 10-week winning streak, especially when you look at some of the price action today. Bit of a struggle on the first trading day of the year, but longer term still looks pretty good. Average returns up on average 8%, median 12.2%, and then roughly 78% of the time the index has been higher. So that momentum begets momentum kind of strategy here when you see these 9-week winning streaks. But I think you could see a little bit of a pause here, at least this week when we look at price action.
Yeah, just like when we started last year, we had a lot of these studies pointing to double-digit gains for 2023, which obviously we got even better. I think this year, these and other studies are maybe pointing to high single-digit gains. So in general, and that's what we're seeing here. Another study that points to high single-digit gains is, after a 20% up year, you on average get a gain of about 9% in the following year. So this is the AAII Bull Bear Sentiment Index. I know our colleague George Smith put this together, and I know you studied this too, Adam. This is a massive move in bulls relative to bears, right? You could see it, with this arrow pointing higher. Pretty rare, and tells me that maybe we're getting close to the point where we have too much optimism, right? And so the next here we have the table of the returns that you tend to see after these bullish readings, where you have a lot of bulls relative to bears, and you see the returns. Well, here's another one: returns, 8% on average after you're in this quintile of standard deviations of bullishness relative to bearishness. We're not in the very bullish range, where you tend to see weaker returns, but the returns are a little bit softer than you tend to see when the survey of individual investors is more bearish.
Yeah, not exactly solid 3-month average return at 1.7%. And I think when you bring this, the collective evidence here in terms of sentiment getting pretty extreme, and of course, overbought conditions getting pretty extreme, that does raise the odds of a potential short-term pause or a pullback. No guarantees, but I think it does definitely elevate those odds. We could see a little bit of softness here, whether it's in January or February, when we start to see that play out.
Yep, absolutely. So you're probably going to get some tax loss or delayed tax loss selling hit in January. Right. And then, because people didn't want to take the tax hit last year and pay taxes this year. So, that's kind of aligned with this study, right? That maybe you'll get that. And we're seeing that today with Apple shares down on an analyst downgrade. Big techs are underperforming. So you might get a little bit of a correction in the big techs that had such a strong year in 2023 as people take some profits. And of course, stocks are getting a little expensive. Yields maybe have found a little floor. So it all kind of lines up. By the way, seasonality in a presidential election year, you tend to see some volatility early in the year. So maybe we'll see that. It just all points to this year being a little bit more of a grind and maybe not an up 20 kind of a year. Hopefully we can do 10, but our forecast, the LPL fair value target on the S&P 500 of 48.50 to 49.50 implies about a 6% return from here, something like that. So not bad, but not. We're certainly not forecasting, another booming year like we had last year. So Adam, the Santa Claus rally, we're losing our gains today, but we have another trading session and a half here. We hopefully can end positive and continue the streak. We have a streak going on the Claus rally game.
Cutting it a little close, I think, with today's price action. We're still above the level, which is going to be 47.47. That's the line in the sand for a positive Santa Claus rally. If you're not familiar with the Santa Claus rally period, it's represented by the last 5 trading days of the year plus the first 2 trading days of the year. It's a seasonally strong 7-day stretch. Your average returns are about, as you can see here, 1.3%. So pretty impressive for a 7-day stretch. And then a lot of people look at this to extrapolate it out into what it means for the rest of the year. It's got a pretty good predictability rate in terms of if Santa shows up and you get a positive Santa Claus rally, you can see the next year returns up 10.4% with 74% of those positive. On the flip side, of course, if Santa doesn't show up, you get the lump of coal. Average returns only 4.1% for the S&P 500 next year.
Hopefully Santa comes. Hopefully he delivered presents to everyone over the last 5 days, but we still got 2 more in this stock market period. So we'll see. Going to be close. All right. So we had a great December. S&P up about 8%, I believe, if memory serves. And now we're going into January, of course, and the seasonals look pretty good there too.
Yeah, so we'll see if the momentum can continue into January. More recently, it hasn't been a super strong month. I think it's ranked 7th over the last, I think it was the last 20 years. I can't remember the exact ranking order, but overall, it's a pretty solid year or pretty solid month for the S&P 500. You can see some of the various return scenarios going back to even 1950. So it has a relatively high positivity rate in terms of January finishing positive. So of course, we'll be looking at the first 5 days of January. There's an indicator goes from Yale Hirsch and the Stock Traders Almanac. And then of course, the January barometer, if January is positive, or as the saying goes, as goes January, so goes the year. We'll see if we get that trifecta, but we got to get that to really get the trifecta, we need a positive Santa Claus rally period. So we'll start there and see how it goes for the rest of the month.
Yeah, all those patterns pointed bullish last year, certainly, and markets delivered. So so good seasonality, but not great. Heading into January, but then we still are in the positive, 6-month period for sell in May and go away. So I know that's looking a little bit further out. But generally speaking, seasonality would be a tailwind between now and April. So let's preview the week ahead, and then we'll wrap. A lot of good content here. So it's a huge week. I mean, last week, most people weren't paying any attention, and there really wasn't any data, any meaningful data, I guess. But we don't get any time to kind of ease into 2024 because we have the ISM and tomorrow, and then the jobs report, or ISM on Wednesday, I should say, for those who are listening to this on Wednesday. the jobs report is going to get the most attention. I've actually seen consensus numbers in the range, depending on your source, between 155 and 170. Right, we were at 199 last month, the jobs report for November. I think there might be a little bit of downside to this number. I mean, this is notoriously a hard number to predict, right? A lot of people following the data, including our chief economist, Jeffrey Roach, more closely than I do, have a difficult time predicting this. But after a 199 and with how strong the economy was, last year, it just feels like we're in a little bit of a slower period of job growth based on some of the other indicators that we've seen. So, yeah, I think something closer to maybe 150, 160 rather than the 200 we got last month makes sense. The unemployment rate's expected to tick up marginally as more people come back into the labor force. That's a good thing. And then average hourly earnings, 0.3%. We want to see 0.3s. That's a normal rate. If you analyze that, you've got 3.6% per year. That's consistent with a reasonable inflation rate, generally close to the Fed's target. Right? We don't have to get wage growth to 2%. We really have to just keep it in the threes, and that should be healthy. So we'll be watching that. We want 0.3s and 0.2s. We don't want 0.4s. Anything else here, Adam, that you think will be interesting for markets?
No, I think you nailed it in terms of the employment report. That's going to be key. I think it's really going to be interesting to see how the market reacts, if it's above or below, and if we can stick to kind of this Goldilocks theme where it's not too hot, not too cool with the labor market. So I think that's going to be a key one to watch. And of course, the ISM data. I think the ISM services will be interesting. Of course, the services sector, big driver of our GDP. So we'll be watching that closely as well.
Yeah, absolutely. The Fed minutes are also coming out this week. We want the economy to slow a bit from that, breakneck pace of Q3. The Atlanta Fed GDP now is at a little over 2% for Q4. So clearly we weren't in recession in Q4 based on the data, but we did certainly slow, and we would anticipate slowing further. Our forecast probably a little over 1% GDP for 2024. I think consensus is 1.4. So we're a little lower than that. We'll have to see, but slowing job growth and slowing inflation is certainly part of that. You would think with a slowing economy. So the data this week should be consistent with that, and we should continue to cement the market's expectations for a pivot. Maybe not 6-7 rate hikes for this year, but certainly 3 or 4 in the back half of the year seems like a reasonable expectation if inflation continues to come down. So that's the week ahead. And I think with that, we'll go ahead and wrap, unless, Adam, you have any closing remarks to launch us into the new year.
No, just wish everyone a great 2024. So looking forward to another year here at LPL Research.
Awesome. Yeah. Thanks, everybody. Hope everybody had a wonderful New Year's. Thanks for listening. It's great. We have heard from some of you directly that you have enjoyed what we do. So please keep the feedback coming. Hopefully, mostly positive, but keep the feedback coming. We'll take all feedback. Appreciate your support. So happy New Year, everybody. Have a great 2024, and we'll see you next week for another edition of LPL Market Signals.